one is I can't buzz my head, and the other is I can't really go with contacts because some of them thinks I look like a murderer. Hey everyone, Stephen from 11ish, a channel where we talk about lucrative investment strategies and opportunities based on the requests from the 11ish. Today I'll bring to you another podcast. I have John with me, who used to be a fund manager, who worked with investment bankers as well, managed millions and millions of dollars, and I pulled him in on these podcasts so that we get a professional perspective on certain talking points where it warrants one. And today it is one of those times because we're going to talk about whether regular investors today, in this day and age, whether they can actually overpower institutional investors in the stock market. So, how's it going, John?
Yo, thanks for having me on.
I feel like we're getting more and more casual every time we talk. Okay, so I think the question is pretty straightforward. Ultimately, this is brought up by the fact that we're seeing more and more news coverage of Robinhood investors. We see a flood of, like an infusion of money by the federal government. And then we also have this idea that most of these people aren't actually using it for survival, right? They're using it as a means of investing instead. So what are your thoughts about them? They're like, there's so much retail money in the market that it's overpowering institutional investors.
Yeah, I 100% agree with that. I mean, I did some basic, very, very basic just analysis the other day just for fun. But assuming like the average Robinhood investor trades about 10 times a year, let's say you have $1,000, and implicitly that implies like over the course of a year, you buy and sell and you rotate $10,000 worth of stocks, which would be, a very high ratio versus institutional investors. So you think about like, generally, hedge funds oftentimes do have high turnover of their book, but usually for the long-term institutional investors like the Fidelity, T. Rowe, and Capital Group, etc., they're probably, a lot of their funds are one time a year or even 0.5 times a year. And what that means is if you manage $1 billion, you actually only buy $1 billion worth of stock every year, or maybe even less. You might actually only be buying $500 million of stock every year. And you flip that the other way around, that means their average holding period is about 2 years. So if you think about the incremental flow, that's definitely coming from the average Robinhood investor, whether that's Robinhood or any of the other platforms. So when I did that math and looking at just basic assumptions of how much money is being held within these different platforms, and if we assume kind of a 10-time book turnover rate, the amount of flow and purchasing power is more than all Fidelity combined. So what that tells me is what I guess you could call the millennial investor or this type of new investor on these platforms is creating tremendous amount of impact on stocks, whether that's a short or long. So they cannot be ignored.
That is fascinating. And I think before you even said this, I mean, like what you just said also makes sense. But my original perspective around this is, I'll just briefly give our viewers a little idea about how stock trading actually works, right? Because most of us who are new to investing, we look at it as, okay, there's a stock, there's a price, I'm buying it, right? Versus what it actually happens is that you put in essentially a bid. There's an asking. There are people who are holding the stock and they have a price that they have in mind. And then you're basically making a bid. So if that price is, let's say, $12 and you want to pay for $10 and no one wants to sell for $10, then you got to wait until someone maybe offers it for $11 and you want to bump your price up. So it's very much like supply and demand, right? That's how the stock market works. And my thought around that is it doesn't really necessarily mean you need billions of dollars. It just means that you need a lot of activity, which is I think what you're
100%.
What you're referring
exactly
to.
Right.
Yeah.
Exactly right. Exactly right.
Which is kind of like how the fucking cryptocurrency market is like getting boosted too, right? You have a lot of activity, and that's kind of driving the price up and down like that, right? And
exactly. It's always a combination of price times volume. Exactly.
And what are your thoughts about the fact that there's a lot of options trading right now? I assume it makes it worse, but like, do we have a perspective of how much worse? Does that make sense?
Very good question. So I'm just gonna call them millennial users, even though I don't know assume a lot of them are not. But anyway,
Yeah.
it's pretty clear that they have no idea how to price options.
Yeah. Yeah.
So if you look at Goldman's, I think maybe not this quarter, but the quarter before that, I believe they reported something like, or maybe I read this in an article somewhere, but they basically reported something like $100 million of profit from basically arbitraging or seeing a incredible mispriced option on Tesla. Everyone was buying the
Interesting.
crap out of options. So then the implied volatility was significantly higher than expected.
Yeah.
And I suspect in that situation, you'd be writing as many options as possible to kind of sell. Basically, you're shorting volatility in that case.
Yeah.
It's hard for, I think, retail investors to price options, especially given you need some basic understanding of block shoals, and even that by itself is kind of the very basics of ABCs of option pricing, and then there's many 3D surface volatility skews and things like that.
Yeah.
So option trading is incredibly difficult, and that's where the institutions are going to kill generally the retail investors. I think retail investors on the flip side are driving momentum and things like that on the normal buying and selling side.
Yeah. I mean, I think John is pointing out something that every other video I iterate, right? And I'm actually iterating this outside of options trading. I'm simply pointing out the fact that if you're buying stocks and the price has jumped up abnormally, then there's a pretty high chance that it's overvalued. And if there's a chance that it's overvalued, there's a pretty high chance that people are going to start selling. Like the legit investors, I'm going to start selling because I think that there's no reason why the optimism should be driving the price this high, right? And so you gotta have to keep your FOMO under control, especially in a crack shoot of a market like this, So options trading is one thing, and then the other thing I was actually really, really curious about is we have a lot of robo trading in today's market. That's a safe assumption, yeah?
Yeah. Yep.
And so then I'm also thinking that, if you have a bunch of noobs who decides to buy in the hype, and then it creates a chart pattern, and that chart pattern does that does that warrant the kickoff of robo trading, kicking that valuation even higher?
It's definitely possible. That said, the robo / quant trading side of hedge funds have actually done really poorly this year. So if you look at a recent article, it said basically Renaissance Capital, which is super famous for basically compounding 40% every year for like the past 20 or 30 years. So yeah, everyone there is a billionaire. But they're actually down, I think, 20% this year, which I think is possibly the largest drawdown ever. And there was I think it was a Bloomberg article. You guys can check it out. But there was a few other really famous quant hedge funds mentioned in it. They're basically they were not hedged enough when things fell, during the March-April time period.
Yeah.
And then the computers automatically overhedged on the way up, which means that they, obviously didn't gain enough money on the upside. So it's not obvious to me that the quant trading side is doing better this year or good at all. Yeah. It seems to me that the funds that are doing really well are the hedge funds that are very skewed towards very, very long strategy. So I guess you could call them a long only in disguise as a hedge fund with fees. But those that are extremely long have done really well, as one would expect.
Where my head was at is that if a stock price is the starting point is, or rather the start of the hype is driven by retail investors, and we agree that boosts the value disproportionately, and then the robo traders kick in and that boosts the price even more disproportionately, and then you have a bunch of people who are just starting to sell off, and both the retail traders and the robo traders are going to get effed, right? That's kind of what my hypothesis is.
Yeah, I mean, that's very possible. So to your point, I'm sure somebody smart out there, in fact, it's not very hard. So somebody with basic Python skills has built some type of ability to understand, this is, what is it, some type of technical analysis on the price or some type of data-based analysis based on APIs coming from the various platforms, i.e. Robinhood, etc.
Yep.
Or, other data. There's so much data out there. But basically, I'm sure people are trying to arbitrage this thing where, if X% of people from, let's say, Robinhood buy the stock in, let's say, a 30-minute period, that implies a 60% probability of this stock going higher in the following 10 minutes,
Yeah.
or something like that. And then of course there's so many AI packages out there. Then you base the kind of big AI package on top of that, and then you backtest the shit out of it. So I would be shocked if no one has done that yet. That said, what is very unique about this market is that this market now is so dissimilar to basically all previous markets in many ways, not just from the virus, but also the extremely low interest rates, the super high price multiples in conjunction with relatively high unemployment numbers, and just weird situation, which frankly we really haven't seen for many decades.
Yeah.
And the issue with quant trading is that you need back test data in order to kind of train the algorithm.
Yeah.
And then the question is, well, is anything even from 2019 and before even relevant now?
Yeah.
So there might be guys that are building some type of model where they're like trying to arbitrage that hypothetical story I just mentioned. But that said, they might also lose a tremendous amount of money because they might use data that's like barely statistically significant. And in that kind of situation, if your margin of error is very, very low, then if you're barely wrong, you're going to lose a tremendous amount of money. So in a nutshell, I wouldn't be too worried about the quant guys in this scenario.
Yeah.
Because I suspect in general most of them don't know what they're doing, or wish they had more data. They probably know what they're doing.
Yeah.
But they wish they had more data in order to inform their models.
Yeah, it's hard to build a informed algorithm without good training data. Absolutely. Circling back to what you kind of said in terms of at least my interpretation of what you said, which is how much risk is actually in this market when it's a combination of unknowns, optimism, and like the edge of things going wrong. My personal perspective and the perspective I've been sharing with the viewers is that I think the deck is at this point stacked against retail investors. Like a lot of things can go wrong right now. There is a possibility that hype will continue on rightfully like build businesses that should be growing, but even those companies are at a valuation that even makes me uncomfortable. And so that in itself has also a probability of going down, right? Like I don't know what Microsoft is at right now, but like I keep looking at it and I'm still scared. Actually, Microsoft's P ratio is 34 right now. That's that's a lot better than the last I checked. But anyway, yeah. But anyway, so I guess my current suggestion to viewers is, sit out, see how things play out, see that Biden actually takes the seat as opposed to having a military coup that we had to deal with. I don't know what's going to happen, right? I mean, like, see that the macroeconomics has some stability before we start investing, because to me, there's always a time to invest and make money. But if you lose your bankroll because you bet during a very uncertain time, then like it'll be very hard for you to recover so that you can continue to make money. That's kind of where I'm coming from. What are your thoughts about that?
There's two parts to what is an uncertain time. I think the markets in general, it seems to me that it's a very certain time. But meanwhile, in the economy, I feel like it's a very uncertain time with regards to like another 6 to 8 week closure or whatever might happen or may not happen. So when I think about it from that angle, implied assuredness of the market, i.e. the price that you're paying, and the lack of assuredness of the underlying, i.e. the economy, that gives me a little pause in terms of the kind of the risk reward here. And you'll see a lot of different articles about different investment banks or fund managers and random people talking about this or that in terms of markets going up or market going down.
Yeah.
I think the most important thing with regards to forming your own opinion is to think about, why is this person saying this? Because if you think about a fund manager or an investment bank, they're never going to say the market is too expensive. They're never going to say the market is going down. Because if you're I think there was an article by like JP Morgan or something saying that the market's going to rip in 2011, 2021. I was like, maybe, who knows? But they're clearly incentivized to do that because they're going to make trading fees and they're going to make IPO fees
Yeah.
and advisory fees and merger and acquisition fees. So it's like, okay, like why would you ever say that the market's going to go down? Because you literally have nothing to go. In fact, you destroy your business if you say the market goes down. So that's like, okay, that's a very biased opinion. Meanwhile, you have someone like a Masa-san at SoftBank saying that right now risk reward looks really, really horrible. And then I sort of trust that opinion a little bit more because at the end of the day, SoftBank, him doing that interview, he doesn't care about retail money, right?
Yeah.
Versus a Fidelity portfolio manager, if you ever see an interview with those guys, they're gonna be like, yeah, the market's the best thing ever because they want you to invest your 401k in their fund.
Yeah.
Versus SoftBank, like there is no 401k for SoftBank. That guy doesn't want your money. He has enough money. So he just says whatever the hell he feels, which I think is the most important. So when I think about the like a Duquesne Capital, the guy that used to work for George Soros, which is a family office, so he doesn't run anybody's money. He just his own money, his own opinion on everything.
Yeah.
And also the SoftBank guy, it's like, okay, well, I believe these guys a little more. You still got to think about what the hell they're saying and not just take everything for face value. But at least you kind of consider like, okay, they are just saying what they actually believe rather than marketing for something to be gained from a revenue perspective.